We mentioned a couple of the differentiators of MLG so far. Jim mentioned our track record. Lindsay mentioned sourcing strategy. Another key differentiator for us is our value that we add on the tax side of things. We're a very tax-focused group. Of the 10 principals or owners of MLG, 5 of them are CPAs. So everything we do is with a unique tax lens and how we can create great after-tax returns for investors as well. So a couple ways we do that, and could certainly have a webinar on tax benefits of real estate on its own. But some of the things we try and do is cost segregation studies, where we're allocating our purchase price to different parts of a building so we can depreciate them faster and create nice passive losses for investors. Bonus depreciation, another way we can get investors passive losses early on in their investment period. And then being willing to sell properties and trigger long-term capital gains so you can release the passive losses you may be accrued earlier on in the fund. There's some really nice things you can do tax rate wise when you're able to do that. But really the punchline here is the funds that we structure are very tax efficient. You can realize some pretty substantial passive losses early on and then utilize those against other sources of passive income in your portfolio or carry them forward for gains you might have in our fund later on.
Yeah, let me put some specifics on that just to give people a real life idea of what that can look like. I'm invested in Fund 4 with MLG. This was a $250,000 investment. And basically the next year, I got a loss in box 2 on my K1 of $157,000. So about 60% of my investment came back to me as a loss in that first year tax-wise. Obviously the money wasn't lost, but through bonus depreciation and cost segregation studies, et cetera. So if you have a need or a use for a lot of tax losses relatively early in the investment, MLG can be a particularly good sponsor to work with that way. Otherwise, they just get carried forward year to year.
All right. So one thing that's really important to know, using Jim's example, is that if you're not able to use those losses that we produce right away from your investment, those just suspend and carry forward to future years. And one of the things that we have found for investors that continue to reinvest year over year over year is every fresh investment that they make gets a new batch of passive losses. And eventually, as we start to sell properties in older funds, we trigger passive capital gain. And then you have passive gain and passive loss. And the presence of that passive gain is the key that releases those losses into your tax picture. But they don't have to stick to that cap gain that's taxed at a lower rate. They can flow into your tax picture and offset whatever income you have that's taxed at the highest rates, including your W-2 income. And here's the punchline that's been really powerful as we've looked at people who have had this continued reinvestment over time. For those that are taxed at the highest rates and have continued to reinvest, their after-tax return from their investments with MLG has been greater than their pre-tax return because they're continuing to grab that permanent tax saving difference between ordinary income rates and cap gain rates. It's really powerful stuff. Like Steve said, we could do a whole webinar just on this, but for this group especially, who's highly compensated, highly taxed, the power of continued reinvestment and continuing to use those losses is really, really juicy when you start to get into it.
Yeah, obviously the investments still have to make sense. They have to make money in the end, but the additional tax benefits are definitely icing on the cake.
Yeah, you have to have some profit tax plan around. That is for sure.
And then just the last thing on that slide too is that it's important for delivery of tax documents on time. And we just wanted to say that we delivered all our K1s out to investors by March 31st so that people could file on time. I know that can be different across different sponsors, but we work really hard on that. We send out, I think, several thousand K1s every year, and that's important to investors.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.